Microphone. All right. I think we're live. So good morning, everybody. Thank you for stopping by and hanging out with us. As always, we'll just give a few minutes for people to roll in here. Usually takes a couple minutes for everybody to grab a coffee and get themselves settled in. So for any of you who's already here, you might notice a difference in the audio. So I just want to say right up front, I haven't really tested this out. I hope it sounds okay. I got myself a new soundboard. So one of the things that bothered me about the previous streams is that the old, the little audio device that I was using, it does pick up on the computer fan. So MacBooks, I don't know if you're a Mac user, it's really annoying. The fan is always spooling up, and it's actually quite loud. So what I tried to do is go out and research how I'm going to fix that during a live stream. I can always do it, in post. And you may have noticed that my edited videos sometimes sound a little bit better than the live videos, but I never figured out a way to do it live. So I bought this soundboard, and it's called a Rodecaster Pro. And inside it has this processor where you can drop the sound floor and you can actually hopefully cut out that sound, so that if I'm struggling to figure out what to say in a moment and there's dead air like that, hopefully you can't hear the fan on my MacBook going. So the only problem with this thing is it's absolutely huge. Have you ever ordered something off Amazon and you get it to your house, you're all excited, and then you see it and you realize, wow, I really should have checked the dimensions before I bought this thing. It's much bigger than my laptop is. And my 16-inch MacBook Pro, that thing's probably a good 1.2 times bigger than the actual footprint and 5 or 6 times thicker. So for me, I'm a minimalist. I travel light. I travel often. I like everything I own in this world to fit in 3 suitcases. So right now I'm good to go. I can have golf clubs, clothes, all my personal possessions fit in 3 suitcases. This new soundboard, it better sound really good. So today's kind of the first test. Hopefully everything's okay. But yeah, it better be pretty good. Otherwise, I think that thing's going to get sold pretty quickly. So apologies if it doesn't sound quite like the other ones. Hopefully it's an improvement, but we will just see. The only way to know is just to test it and go from there. So I'll watch the rebroadcast and make some adjustments. So let me just do a little 1 minute of housekeeping here. Just give everybody another minute to get their coffee together, and then we'll get started. So bear with me here. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. All right, so the reason I wanted to do this stream, of course, is we had some, I don't know if it's exciting news, but it's certainly something new. A reverse split announced in the VXX, and since a lot of us are volatility traders, what better time than to just jump on a stream? There's bound to be plenty of questions, people wondering what it means for the options and whatnot. So yeah, it was just keep it casual, and I will go over a bunch of things here. But one thing I do want to point out is I do also give heads up for the live streams on Twitter. So I don't know if you're following me from Facebook or LinkedIn, wherever you found this, maybe the emails from the VTS community. But it is probably a good idea to follow me on Twitter as well, because on Twitter specifically, it's very easy to bump a thread and just remind people we're going live in a few minutes, whereas the other platforms, it's not really possible. So go ahead and follow me on Twitter, the ticker there, or my handle, @VolatilityVix, and you'll always be notified of all the live streams. And as well, I'm not overly active on Twitter. I don't really value it as a platform that much, but I do from time to time, anything interesting is happening, I will be posting volatility specific takes on what I think of it all. So go ahead and do that. And let's get started talking about this reverse split. So thanks everybody for coming. Have a little bit of a rundown here if you're wondering what we're going to be talking about. First of all, the actual split itself, what effects does it have? How are the shares adjusted? This is a common question that will be asked. Some of you are trading options because this is VXX. It does have a very liquid options market as well. How are those going to be affected? And then we'll talk a little bit about why they're even necessary. I know some of you will know why the answer to that already, but we'll talk about it. And then lastly, I know that afterwards, when I'm done talking here, we're going to do an open Q&A, and there's surely going to be a bunch of questions about UVXY. So I'll kind of nip that in the bud a little bit, and we'll talk about when that one would potentially do it. So let's get started with the actual announcement of this reverse split. So here it is here. Barclays announces the reverse split of the Series B S&P 500 VIX short-term futures ETN. This is the VXX, the original product that launched on January 29th, 2009. So the reason it says Series B really quick, just this is the second version of it. The first one had a 10-year shelf life. The one that we currently have now has a 30-year shelf life. So this is going to be around an awful long time. And it's the most popular, doesn't have the highest volume on it. I think UVXY is significantly higher at this point. But the VXX is the one that you always want to default to. It's basically the baseline of all the other volatility ETFs out there. So they have announced a 1-to-4 reverse split. And that will be taking effect on Friday, April 23rd, 2021. So how this is going to work is the indicative value, the settlement value of the ETF on the 22nd, so Thursday, April 22nd, whatever the price is at that moment, they're going to be doing a reverse split based on that. So that's when it will take effect, whatever the price is at the time, that's what they're going to be doing. I'm just going to, forgot to load up my little checklist here just so I don't forget too many things. Live streaming is a little bit tough. So the first thing that we're going to look at is the split history, right? We want to get an idea of how normal this is, how often it's happened. So this is going to be the 6th, I believe. We'll see in 1 second. Sorry about the size of this spreadsheet. So this is the VXX over here, split history. This will be the 6th reverse split since the inception of the product. And it's actually been quite a while. It's been, since August 2017, since the last one. Obviously, the VXX goes up substantially when markets crash. And because we had the Volpocalypse, we had the Q4 2018 crash, we had, of course, the COVID disaster, it actually hasn't had the need to reverse split. But we are finally here with one solid year of really good performance in the market. So the VXX has collapsed in price. And there it is. So at last print, it was 1031. We'll see what it is in a week or so when it happens. But we can see that it's actually not that abnormal. This is about the normal time when the VXX would be looking to do the reverse split. There's been 3 of them that happened at a higher price, a couple of them that happened lower. But essentially the way VXX is designed, anytime it gets under $25, it is subject to a potential reverse split. That's when they can start considering doing it. And it's always going to be a 1-to-4 split. So this time, got close to $10 and they're going to do the reverse split. We will talk about this one in a second, so we will leave that one till the next segment. But that's basically what they do. They just reverse split it. It's very easy. What we really want to know, and what I think a lot of you are wondering, is what effect does this reverse split actually have? What ends up happening? And the bottom line is reverse splits don't actually do anything to the underlying trading mechanism. In a practical sense, it will happen as if nothing happened. It's just a very simple process. It happens all the time. Individual stocks, as we've seen, volatility ETPs do this quite regularly. Absolutely nothing will happen. So what we want to look at is Sorry, I'm a little bit all over the place. The one thing that I wanted to point out is a lot of times when I say there will be no actual effect on the product, a lot of times people push back on that and they will say that after a split, say for example, Apple, when Apple did that 7-to-1 reverse split back in 2014, not reverse split, normal split, some people would argue that if it goes from $700 down to $100, that will be a more accessible market for people and they can actually bring in more people buying the stock, and that might in turn cause the price to go up further. So some people might be under the impression that doing a split might actually change the forward prices. Now, there's a couple reasons why in the volatility space this doesn't matter. The first one, of course, this is a reverse split, so the price will actually be going higher. But the second reason, the one that we really want to focus on, is that these products don't actually trade based on supply and demand. So even if that was true, which I've not actually seen much data to support that, by the way, that splits affect forward pricing. But even if that was true, in the volatility space, these products follow underlying indexes. They are set methodologies that do not change based on how many people buy or sell the product. The VXX itself is based on rolling VIX futures. It holds a combination of VIX futures, front 2 months, right? The M1 and M2 as we call them, a combination of these two futures based on how much time to expiration and the value of this contract as it approaches the VIX index during those expiration cycles, that's what causes the changes in VXX price. So this underlying index, this is essentially the VXX. Exact same methodology. Price is obviously a little bit different, but the price is irrelevant. The methodology is what we're interested in. It is holding a 30-day constant maturity future. I call it the VX30. And that's really all that matters, the value of that VX30. So since this underlying index is not going to change after a reverse split in any way, shape, or form, the VIX futures, these prices will not be adjusted whatsoever. The VIX futures are totally independent of this happening. These won't change. Then that means, of course, the underlying VXX doesn't change as well. The price of the VXX tracks with what is called an intraday indicative value as close as possible to this underlying index. And a reverse split, even if you could make a case that it will make a bunch of people come into the market or whatever it does for it, that still won't have any effect whatsoever in the price of the product. And these kind of things are actually very important to understand, because if you're trying to trade these products for profit, you have to know how they work. And one of the byproducts of understanding how this product actually works, that the VIX STR index, is that you can actually use that to understand that the reverse split will do nothing to the product. Absolutely nothing. It's based on VIX futures, and that's all it is. So if you want a more detailed explanation of this, I do have on the YouTube channel. If you go to my normal YouTube channel, on the front page, you can go to videos, and the one you're looking for is this one here. It's called VIX Futures Expiration, Contango is Lower Than You Think. I've got several. You can actually go to this little search function and type in VIX Futures. If you really want to know how these products work, which I would suggest everybody do if you want to actually trade them for profit, there are several videos I've done. I don't know how many on the VIX Futures, many. But I would start with this one. It's just a 20-minute video. After watching that, you will understand the full process of the VIX Futures expiration cycles and how all this works. So check that out. The bottom line is splits don't actually have any effect on anything. It is just a nominal number that is going to be changing. Share count's going to be changing. So let's actually talk about that really quickly. It's a very simple process. But how are the shares adjusted? So essentially a reverse split, they announced a 4-to-1. So all that's going to happen, let's just assume for simple math that the VXX on April 22nd is $10, right? Just for easy math. All that's going to happen is on the morning of the 23rd, you're going to wake up and you're going to see that the VXX is $40. All things being held constant overnight, let's say it opens at $40. That's really it. And then all they have to do is adjust the share count, divide that by 4, so that it's the exact same ratio as it was before. 4 times the price, 4 times fewer the shares. It is exactly the same thing. No value changes hands whatsoever. Now, the only thing to be aware of is that when you are doing a reverse split, you're dividing the shares by 4, which might leave people in a situation that partial shares come into play. So let's say, again, for easy math, you are holding 101 shares of VXX on the 22nd. You're going to wake up the next day and you're going to have 25 shares of the VXX in your account. They will adjust that for you. You'll now have 25 shares and the share price will be 40. So your value won't have changed. The only difference is that one single share, essentially they took that away from you. So they can't take 101 divided by 4 to get to 25.25. You're not going to see that 0.25 in your account. Instead, what they're going to do is, I believe they announced it on the 29th. On April 29th, they're going to settle all this up and they're going to look at those partial shares and give you a cash disbursement of whatever that share was. So your 101st share of VXX will just be paid out to you in cash. You'll have 25 shares of VXX at a price of 40. And then after a little bit of time goes by, you'll be paid a little bit of cash to make sure that you are completely square and no value changed hands. So that's the process. It is a little bit different on a reverse split because, of course, they're not multiplying, they're dividing. They don't want to do partial shares, which now brings us to this fourth one. How are the options affected? This is something that a lot of people get spooked on. If you're holding options and you're going into a reverse split, some people wonder what's going to happen. Are they going to adjust all the premiums? Are they going to, is it going to look really weird? It can. I don't know for sure how they're going to handle this, but typically, in the case of a normal split, it's much easier because you're multiplying things the other way. So the options are just adjusted in very similar ways that the stock is adjusted, and there's no change in value. Options, however, is a little bit weird because, especially in a reverse split, you are now dividing by the number of contracts. So what they will very likely do in the case of a reverse split is, instead of changing the strike prices into decimal points, instead of changing the premiums and changing all that into decimals, which it would look a little bit weird, what they will probably end up doing is they will introduce a temporary benchmark that this is going against. So let's call it VXXB. Actually, let's not call it B because there used to be a VXXB. Like I said, the 10-year shelf life ended. They used a little bridge ETF called VXXB, and then they changed the name back to VXX. So I don't want to confuse anybody. Let's call it VXX2. The VXX2, or VXXA alternative, whatever you want to call it, they will just use this as a short-term bridge. And as we know, one option contract equals 100 shares of the underlying. So whenever you hold one contract of VXX, technically that is squared at the end, whether assignment or you just cash value, to 100 shares of the VXX. All they really need to do in this case is make that little VXXA, or VXX2 as we're calling it, all they have to do is just for a short temporary period, make that 1:25 ratio. That's it. So instead of one contract settling to 100 shares of the underlying, they just have to make one share settle to 25 shares. And that way they don't have to go back and deal with all this decimal points. Very problematic for the options world to be dealing with clearing options in decimals and all that. So very likely there's going to be absolutely zero effect. If you are holding options, you probably won't even really notice what's happening. You might see some new contracts showing up. Market makers are going to get into the new ones, but you probably won't even know. It's really no effect. Now, having said that, there is one thing that you want to keep in mind, and I always remind people of this, just as a best practices thing. It doesn't negate everything I've said. There literally is zero effect here. Practically speaking, in the trading, it won't affect anything. But if they are using that bridged, VXXA or whatever it is, you might notice liquidity gets a little bit lower the longer it goes past that reverse split date. So for me, like I said, just best practices. I can't tell you what to do, but in my opinion, it's probably a good idea to just close down your option trades that you have open and then reestablish materially similar positions with the new contracts. That way you don't run into this potential problem of liquidity getting reduced over time because, of course, everybody trading the options is going to be getting into the new contracts. The market makers are going to give us new option chains. And so that's the only thing to be aware of, that while it's technically not going to affect anything, for me personally, we trade the VXX in a couple of our VTS strategies. And I know for me, I'm going to be closing those out. And I can very easily just close them and then open materially the same trade for further out in time, and nothing will be affected. And I don't have to worry about after that product starts to see dwindling, liquidity. Again, volatility product liquidity means something a little bit different because share creation isn't quite the same. They can basically create shares. But look, just for best practices, not a bad idea to just be aware that liquidity can be a small issue. So would be nothing wrong with just closing out, reestablishing. It's the same trade. Just, I would say that that's certainly what I'm going to do. I can't tell other people to do, but that's something to be aware of. So this point number 5, why are reverse splits necessary? This is something that I would imagine, as people following my streams, all of the volatility traders out there, some of you probably know the answer already, but this will be just a quick little review of basically the methodology of this VXX and why these reverse splits are necessary. And trust me, one look at a long-term chart of the VXX and you will realize why this stuff is necessary. So let me just scroll through all this, and we'll pull up a chart of the long-term VXX since it launched on, this is the VXX right here. It launched on January 29th, 2009. So we'll actually look at a logarithmic chart. It's a little bit easier to look at. And you can see what's happening here. The product launched. This is all live trading, officially launched, and this is the performance of it. Now, if you look down here, it says price on January 29th, 102,396.72. And now it's all the way down at last print to 1031. So this thing is down an insane amount since it launched. You can see all the reverse splits there. This will be number 6 when it happens. Now, if you're curious, of course, again, I'm speaking to people who probably know this, but it's never a bad idea to review stuff. The reason this 102,400 is sitting there, the VXX never actually showed prices that bad. This is what is called a split adjusted price. So this is all adjusted retroactively after the splits. If you want to know where that number comes from, it's actually very simple. Just pull out my little calculator here. You can just start with $100, which is what the VXX launched at, more or less, all the way, 12, 13 years ago. That's what it launched at. You can just add in the 5 reverse splits, right? We're just retroactively split adjusting this thing. And there you go, 102,400. That's basically what it launched at all those years ago. Again, it never printed that. The VXX probably anywhere from, single digits up to hundreds, low hundreds. But they always do these reverse splits. And the reason this is happening is, again, we're getting back to that methodology. This is not people buying and selling the VXX causing it to go down that much. It's not because a whole bunch of people are shorting it. It's actually, let me just check to see I'm on screen share. It's unbelievable how often I make that mistake. The reason that it's happening is because the methodology of rolling these VIX futures, these front 2-month VIX futures, it's always holding a combination of these 2 futures. And based on how those prices are moving around, that's where the pricing of VXX is coming from. So what we know about the VIX futures is that what you see right here with this, call it M2, being higher than this one M1, this is called Contango. And if the VIX futures are in Contango, that is not a forward prediction of prices, but it just means that all things held constant, if that situation persists, then that will be a headwind for the VXX. Don't look at Contango as some, unified trade signal that it's a green light to just short this thing. That's not what it is, but it means that basically on balance of probabilities, there is now a headwind for this product. And then these 2 futures, M1 and M2, being above this green line, this is the VIX index, that is called roll yield. When these 2 futures are above, it's a positive roll yield. Again, positive roll yield, it's not a signal to go do anything in the market, but it is showing us that there is a headwind for the VXX. So it is actually quite important to know how often this is occurring. The reason the thing has gone down so far, we can see it very clearly. You can see the long-term M1, M2 VIX futures Contango, it averages 6.3. So long-term average, this thing is in Contango. And the number of rolling days it's in Contango, 83.45%. It's only 17% of days that this isn't basically showing a headwind for the VXX. And the VXX itself, the pricing mechanism, it's actually far more important to focus on the roll yield, right? Remember that constant maturity VIX future contract, the VX30. The VX30 compared to the VIX, this is even more relevant to what the future pricing might end up being. Again, not a prediction, just an all things held equal kind of thing. 82% of the time, we have positive roll yield and a long-term median of 8.3. So if you're looking at a situation where volatility products have a fairly persistent roll yield working against them, this is why the product continues to bleed down. Now, there might be people out there saying, well, okay, so who cares? Let's just let this thing spike up and just let it go. Well, the truth is this ETF would get down to very, very low numbers, unmanageably low numbers very quickly because of that constant persistent roll yield working against the VXX. We don't want to have a product that's in the pennies or less than a penny, fractions of pennies. This, this isn't Bitcoin where you can have super tiny fractions of something. We want to keep this ETF going. And so what they're going to be doing is just every now and then when it's time to do it, anytime it's under 25, they can start to do that based on the methodology. But typically around $10, they're just going to take it back up to 40, rinse, repeat. We're going to do this whole thing again. And so this VXX has a 30-year shelf life. Who knows how many of these we're going to have, but there is actually a persistent headwind against that. Now, of course, go to my YouTube channel, make sure you understand, watch a bunch of these videos, and understand that just because a chart looks like this does not mean that's a green light to go out and short it. It doesn't work that way. Shorting this thing is also a losing proposition. It's a hard thing for people to wrap their head around that something that looks like this, if you short it, you will also lose money. On a rolling basis, that is actually how the math works out. So don't let this chart fool you. There's a lot of people out there that will, maybe they have a Twitter account that they want to, gain popularity on. Oftentimes they'll flash that VXX chart looking down, or the UVXY, it's even worse. And they'll just try to make a case that, okay, you just short this thing. And then by proxy, the followers who are following that Twitter account will think, that guy must be making a whole bunch of money. He must be an awesome trader. When in actual fact, going long and going short is both a losing proposition. I'll mark that on my calendar to do a extended YouTube video on, but the truth is that is not the case. So I don't want to flash this and irresponsibly get everybody in the comments thinking, wow, all I have to do is short this thing and I'll make a bunch of money. Please don't do that. Can't tell you not to, of course. I can't give you any personalized investment advice. Please don't do that. It doesn't work out that way. So the last thing that we want to talk about, of course, and I don't have any hard answers on this, but the UVXY, if you were to ask pretty much every volatility trader, say 2 months ago, which one of these things is going to reverse split first, I would say 100% of people would have guessed that the UVXY would split first. And it hasn't. It's actually dipped below 5. So I did a live stream, I want to say about 2 months ago, where we were actually trying to predict when the UVXY would be doing its reverse split. So as we know, the UVXY decays minus 2.1% a week, long-term average. So this is what it looks like on a long-term chart. Every 5 days, long-term average, 2.1% a week. If you care, 8.5% a month. But because this thing is decaying so fast, we were actually just for fun trying to predict the actual date where they were going to reverse split it. So what I did at the time, it was about $10 back then. I can just input the daily decay of the UVXY at a 1.5 times leverage factor. And we were basically saying that somewhere around 8, I would suspect they're going to do the reverse split. And so that was 55 trading days from the date that I did that stream. So that would be, 2.5 months. That's basically right now. So the VXX, based on forward predictions, should have been around $8 right now, and they definitely should be considering doing a reverse split. We can always graph it. Nothing is guaranteed. Remember the VXX, sometimes it splits at 12, sometimes at 8. There's nothing guaranteed. It was just for fun. But they should have done it already, and it should have been at 8. The thing that I find very interesting is that we've seen such extreme vol crush. Let me see if I got something to show that. Yeah, this one. What this chart is showing is the rolling 20-day performance of a short VXX position minus the rolling 20-day performance of a long S&P 500 position. And the long-term average is 2.65, meaning that short vol outperforms long equities on average about 2.6. Now that includes all the crashes as well. So typically in a good market period, we would be looking at about 10 to 15, maybe 20% of excess short vol crush. But lately, we are actually in the 99th percentile. Vol crush right now in the market, if you've noticed how low the UVXY has gone and the VXX has gone, it's because the current value is 30%. 99th percentile. We are seeing insane vol crush in the market right now. And that has pushed the UVXY to under 5. I think it printed 485 or somewhere around there on Friday. So, I mean, I don't know what they're doing. Like I said, I don't have any answers. I would have definitely thought that they would have reverse split this thing by now. Again, it doesn't technically matter. So when the reverse split happens, it's not like people can breathe a sigh of relief. Oh, finally I can start trading it again. Remember, literally zero effect. When they do that, it is simply a price difference. Adjust the share count. Nothing happens. Any trade you wanted to do before, like right now, same trade can be done during and after a reverse split. It does nothing. It's just one of those interesting things where you kind of wonder what the folks over there at ProShares are doing, letting it go this low. It's not like this wasn't telegraphed ahead of time. And again, when we're talking about UVXY, they should be actually even more proficient at this because it happens more often. I mean, they should have contingencies already. I don't understand why they're doing this. If they let it go too much further, they're going to have to do these 1 to 10s again. Now remember, all of these all happened when the UVXY used to be a 2 times leverage factor product. But on February 27th, 2018, they deleveraged it from 2 times to 1.5 times. So they might actually have to, if this goes much lower, they might have to go from the 4s up to the 40s instead of doing, a 1 to 4, 1 to 5, whatever they do. I don't really know, but just to kind of answer everybody's impending question when we open up the Q&A here, I do not know. Who knows? I tweeted out recently, let me see if I can find it for you here. Am I doing a screen share? Almost made that mistake. Let's see if I can find this on Twitter. So, first of all, again, just a reminder, follow me on Twitter because you'll always get notified of everything that I do. So at Volatility VIX, just give me a quick follow. But one of the things that I tweeted out recently was this one here. Not pushing any conspiracy theory, but if they just didn't want to manage UVXY anymore for whatever internal reason, wouldn't not reverse splitting be the first place you'd start that wind down process with? So again, not pushing any theories here. UVXY is a wildly successful product. Especially after TVIX was gone, they've sucked up a lot of that volume, and I think it's well over 2 billion at this point. I'm not suggesting that they're trying to scuttle this product. But when they do that, you have to understand, remember when the TVIX was delisted, they don't just remove it and close it down, because if you do that, you actually have to square up with the value of the contract. You actually have to pay out to close that. Nobody's going to lose their value if they delist something. Everybody who's holding it has to be paid back their money. So the first thing you do is you'd want that price to be as low as possible with as few people trading it as possible. That would be good for them before they actually close it. It would save them some money. So I suspect that's why they're letting TVIX go on the pink sheets and just hoping that it dies a slow death because it decays so much. Again, 82% of the time, we've got positive roll yield in the VIX futures market, the VX30 to the VIX. So that thing is going to go to pennies. They just have to wait it out. And, not having the share creation available anymore, it's not going to track the indicative value anymore. It's going to be a nightmare, and people are going to not trade it anymore. So the first step to doing that, especially if you've got a product that faces such a strong headwind like UVXY does, not pushing any conspiracy theories, but you wouldn't want to do a reverse split, would you? So again, don't run off and say, oh, wow, this volatility expert, he told me that they're doing it because they're going to kill it. No, it's a wildly profitable product for them. But I find it just interesting. We're just watching time tick down. We're all just waiting to see it. And my friend David Lincoln, I'm sure some of you know him. He's on YouTube. What is his actual official name? I want to get this right. He has a YouTube channel as well. You should definitely check his out. He's kind of in a competition always to be the first one to announce the reverse splits, which he nails it sometimes. Sometimes Vance Harwood beats him to the punch. But what is his YouTube channel? You can just search David Lincoln, or you can search VIX Crush or the Short Vol Show. But yeah, give him a follow as well. But he'll be on the ball. So if you follow him on Twitter, it's at @TheFamousDave. And he'll let you know when this split finally happens. Again, just to summarize though, for the VXX specifically, no effect to the contracts. They're just it's gonna be 4 times the price, 4 times fewer shares. You're gonna get paid back if you're a holder of VXX based on any partials. They're not gonna do decimals. They're gonna be a cash settled for those. For the options, again, you're not gonna see anything terribly weird on the front end of the platform, but just know that they're probably gonna adjust that settlement to be a temporary 1-to-25 ratio as opposed to the typical 1-to-100. But doesn't matter to us. Again, I would suggest that anybody out there, just general statement, probably don't hold your options through the settlement date. Just reestablish, and yeah, it's just best practices. I always think it's a little bit safer to plan ahead for things like that. Oftentimes when people are option trading, one of the biggest problems they have is they're focusing so much on getting into the trades that they often forget what will happen and how difficult it might be to get out of the trades, right? If there's some massive liquidity crunch, a la Volapocalypse in 2018, sometimes it is a lot more difficult to get out of the trade than get into it. So we have to be forward thinking, and we have to sort of factor that in. So personally for me, I'm going to move my community out of any VXX trades, and we're just going to reestablish basically the materially identical trade. So that's it. Pretty simple, but I did want to touch on a number of things there because it's always good to review. Understanding these products, I understand it's a little bit tough. There are still people when I say things like, hey, it's not caused, price doesn't change based on supply and demand. People are, what do you mean by that? That doesn't make any sense. There's certain things like that it's always good to review. So thanks everybody for hanging out and checking. I haven't looked at the comment section, but we can do that now. I always like to do an open Q&A, so you can ask questions on what we just talked about. That's totally fine. Or literally anything. Don't care. Ask me anything. Opportunity for all of you to just hang out with us. In our private VTS community, we do these regularly. We've done, I don't know how many at this point. I'm not going to plug anything here, but just know that we do a lot more live streams privately than publicly. But yeah, you can just hang out with us anytime. Check me out on Twitter. You'll be notified, and grab yourself a coffee and join us. So let me just review here. Let me check out these comments. I have been actively trying to keep my streams shorter. When I did the first one, I think it was 3.5 hours, and then they were 2.5, 2:45. Trying to get them in there at about an hour 15-ish. So we will see. So thank you, sound. Yeah, this monstrosity of a soundboard over there. It better sound good, or it's going to be gone. Thank you very much for the confirmation there. Okay. Winston. Don't know. IB, I find, I don't know what IB sent you, but I find that they are really good at that kind of thing. As far as tax forms, notifications, anytime that you're holding options that are approaching expiration, they'll let you know, especially if they're in the money. So I don't know. Maybe they just dropped the ball on that one. Maybe they have not done it. Another thing too, perhaps let's just give them a little bit of time because this was only announced yesterday. And, I don't know. It's not that important because it doesn't affect anything, like we said. But it would have been good to know. So IB overall, I have a really good experience with IB. I use both Interactive Brokers and Thinkorswim, and I love them both. So hopefully they'll notify you soon. When was the announcement? It was yesterday, I believe. It was yesterday at about noon, or noon for me, I guess. And again, just to recap, it'll be on April 23rd, but technically they'll be using the settlement indicative value from April 22nd, Thursday, April 22nd, and then on the 23rd, active trading, you'll see the adjustment made then. Okay, here's a question for VTS specific, but you might learn stuff. I like to hash over the same things over and over. I have a lot of patience with this type of thing. I've been doing it for 10 years. I've answered everything 10,000 times, but I don't mind doing 10,000 more. So regarding the vol trend overlay, will you just tell us the correct allocations in every email, or will you teach us how to allocate the correct allocation size ourselves? Absolutely, I'll tell you exactly what I'm doing with my own portfolio. And, that's what VTS is. It's not really a service that I'm trying to do things to convince people to sign up for stuff. I've always said I don't do marketing. I don't do any of that. It's just me managing my own portfolio and sharing it with the public. So obviously, I'm going to tell you exactly what I'm doing, contract sizing, the reasons. It's going to be a full private community where we're going to do live streams, private streams, and I'm going to teach you how to boost your performance of your portfolio if you happen to have a margin account in a safe way. Of course, there's a million ways that can go wrong, but I've been doing it for a number of years in a very safe way. So that's what it's going to be. As far as me teaching you how to do it yourself, well, yeah, you're gonna learn that. I'm not gonna pull any punches. I'm not gonna withhold any information. You're gonna know why I'm doing the things that I'm doing. So it will probably be a little bit different than the standard community where, we've got nearly 1,000 subscribers. I can't manage everybody's different accounts and whatnot. I have to just say what I say based on my own portfolio. But this private community, I can probably say a little bit more than I normally would. So yeah, hopefully, it's a work in progress, and hopefully it just gets better over time. Okay, Super Dangerous Mouse asks, why is the VIX futures term structure in Contango? And what is your measure of the curvature? Do you have a methodology that translates the SPX vol surface to VIX futures? Exact replication. Well, you don't need to do that because the volatility products are, how I would say, extremely simple, but not easy to trade. So what I mean by extremely simple, there are very, very few moving parts with respect to the pricing of the VXX. It is absolutely just the value of those futures contracts they hold, as well as any swaps that they take into account as well. But it's essentially just those front 2-month VIX futures, the value and the changing values of those futures. So the connection there between the SPX isn't important because the VXX trades based on the VIX futures. The VIX index is based on the SPX options market. But no, we just study the VIX futures term structure. I don't exactly know what you're asking here, but first of all, why is it in Contango? Well, it's in Contango because that's the normal state of things, right? And it makes logical sense why the futures would be in Contango most of the time, right? Because these are all the futures going out in time, right? We've got this one here, which is the April, May, June, all the way out. In a normal stable market, you would have to have prices higher further out because there's more uncertainty there. With more time, there's more uncertainty. And traders need to be compensated for taking on the additional risk of forward uncertainty. So, anything can happen in the next 1 or 2 days, but certainly more bad things can happen over here. So under a normal stable market where everybody's making rational investing decisions, we would expect this to be an upward sloping curve. It kind of has to be. So that's you asked why it's in Contango. It's in Contango because to entice people to be trading this contract does require a little bit of additional premium. You can't just go based on the standard price today. There's more uncertainty in May than there is in April. Now, when this flips around, that's when the markets are showing irrationality and fear and panic, and this can flip into backwardation. But like I said, the vast majority of the time, those futures are going to be in Contango. And that's essentially the reason why. This is human nature. We are always going to fear and need to price in forward uncertainty. That's just human nature. The volatility risk premium that we see in the market, implied volatility for the most part being higher than realized volatility, this gets to the very heart of human nature. It has to be that way. So the VIX futures are a freely traded market. It can arrange itself any way it wants to arrange itself. But in a normal, rational market, it's going to arrange into Contango. So that's just why it happens that way. And we can track those, and we can go much further than just the Contango. Like I said, there's roll yield, there's cash term structures. We can check the correlations and the betas and all the intercorrelations of all of those metrics, and we can use it for our trading. But as far as the actual VXX and the futures itself, it's extremely simple, hard to trade. No effect on options. Yes, no effect on options. We covered that. Do I need to say anything more on that? No, I think I probably covered that. Jim, with market valuation at all-time high, is it too risky to invest new money with the VTS strategy? Should we wait for a pullback? Well, the reason that I always stay fully invested with my strategies, there's two reasons. Well, there's probably many, but two that I'm going to highlight. The first one is I have no idea what's going to happen tomorrow. Anybody who tells you they know where the markets are going, they're probably selling you something that isn't worth buying. So I don't know where the markets are going tomorrow. I have to assume that it's just as likely that they continue to go up as they crash down. Let's call it a 50-50 proposition. In that case, we've seen plenty of periods in the past where markets can remain pushing higher for far longer than people realize. I remember thinking back to personalize this, right around 2014, I went through a period mentally in my investing where I was starting to convince myself that the markets had gotten way ahead of themselves, that we were definitely going to see a double dip. What happened in the financial crisis was not fixed. Nobody was held accountable. No regulations were changed. I sort of had it in my head that, you know what, this is probably going to go south pretty quickly here. So it's going to be running on fumes. Well, thankfully, I don't allow my personal predictions to influence my trading. I am a pure quant-based systematic investor because I would have missed out on an insane amount of gains over those years. I mean, just my short vol strategies alone for the last 10 years, I would have missed out on all of that. So I always assume that I don't know what's going to happen tomorrow. I do a lot of data mining and calculations to make sure that I have basically I'm on the right side of the probabilistic equation. On balance of probabilities, I can make reasonably good guesses as tomorrow, which is why I'm long equities right now, because all of my metrics are telling me that, well, Monday's more than likely, all things being held equal, probably going to look like last Friday. So that's basically it. I don't know what tomorrow brings. And believe me, markets can continue marching higher long after our gut starts to give us warning signs. And you can miss out on all that. But the second, maybe more important aspect is every one of my strategies can cycle out of aggressive positions and into safety positions on a single day's notice. So there's no reason for me not to just trade forward, right? This is my website. I'm just going to grab a random example of a strategy. The leveraged tactical balance strategy. Well, it's doing very well. Should I exit this because I feel in my gut that the markets are going to be crashing sometime soon? Well, no, I don't need to do that because this strategy is completely systematic and 60% of the time we're holding stocks, but we can easily rotate out into the IEF and into the GLD on a single day's notice. It does not take very much for me to get pushed back into safety positions. So we can actually go to last Friday's email, which was this one. There. For my volatility metrics, this is all I really care about is what is the market actually doing? Not what I think it's going to do. What is it actually doing? And what it is actually doing, it is a pretty strong market. There's no reason not to be long equities or short vol right now. That's not a recommendation. That's just my opinion. That's what I think. That's why I have been for a long time, long equities, short vol. But if this changes, if the volatility barometer spikes up, over 55, 60%, which can happen in a single day, then what's going to happen is I'm going to send out the trade signals. Okay, we're rotating out of MDY and into IEF. We're going out of VXX puts. We're going to cash. We're going from SPY to TLT, and we're going to move into utilities. That's easy enough to do. So I don't have to make any predictions of any kind. I don't have to bother myself with that. I just have to make sure that I have strategies that have a long-term track record of rotating out of aggressive positions and into safety with maybe only 1 or 2 days of friction there. And then, boom, I'm out into safety and everything's fine. But if I start trading based on predictions, it's very quickly going to go to 50-50 because, again, my crystal ball is completely broken. It's no better than yours is. So I understand what you're asking here. And I think when markets hit highs like this, especially when we've still got some lingering doubts and we've still got massive unemployment and I can't even go to a restaurant and get a steak, it feels like this is all just totally irrational and silly. But with relation to trading specifically, I don't care. The metrics tell me what to do, not my predictions, and they'll catch it. They will. I mean, I have 12-year track record of rotating to safety very quickly. So for me personally, no, I'm just going to follow the metrics. As I always say, I'm going to put my head down, trade the signals as they come, as if I'm a cyborg. That's my job, is to do tens of thousands of hours of study to make sure the strategies are really good and stable and able to read signals quickly. And then my job is to just follow it like I'm a robot. And so that's what I'm going to do personally. I obviously I can't tell you what to do, but no, waiting for a pullback, no need. I'm bouncing back and forth between tactical positions always. And cash is an active tactical portfolio position. So our short vol strategy could very easily move to cash. And that's an active portfolio position as well. So there is an effect on options in terms of sizing, but just not pricing. Yeah, I mean, there is, again, it's one of these very insignificant things, but you might want to at least be aware of it. There's nothing we can do about it. But if you imagine the number of contracts that people are buying and selling, if it's a normal split, then the price is going to be going down further. You might have to buy several more contracts, and it might actually cost you more commissions. If it's a reverse split, it's going the other way. We'll be buying less contracts of the VXX in our future trades. Again, it would affect pricing, commissions a little bit, but we can't choose not to. I mean, it is what it is. The price they give us is what it is. It might have a positive effect on commissions going forward for option traders, and that's really, I mean, just being aware of these types of things. Another one is we use stock replacement in one of our strategies. It might affect stock replacement slightly. I mean, just a very minor inefficiency that going from 10 to 40 does change the dynamic of how much capital is required, and certain really small trading accounts might notice it. But, these are just, you just take what they give us. Unfortunately, we can't make our own ETFs. So existing VXX will be renamed and set to close only. VXX option. Yeah, you might see some weird things. I mean, when I said that you won't see anything weird, when there's a normal split with the options, sometimes you actually do see some weird things that'll kind of surprise you. You'll see fractional things and decimal points, but when you're doing a reverse split, it is much easier to attack it from the 1 to 25 versus 1 to 100 range. So I'm not exactly sure what it's going to look like on your, the front-facing platforms. It should be fairly obvious what's going on, though. But again, we, the VTS community, are going to be rotating out, and we're not going to hold through that. Okay. Yes, I will close my short and long VXX option on the 22nd. Yeah. I don't know if it's going to be on the 22nd. Of course, we'll look for the most advantageous day to do it on, but it will almost certainly be before that Thursday, the 22nd, when that indicative value, and then wake up the next day and it's live. We'll do it before that happens. Okay. Oh no. I can take a guess what this means. UVIX? Well, maybe not. UVIX. So you probably mean UVXY, but on the off chance that you don't and you actually mean UVIX, remember I did a video recently talking about how, let me get the YouTube channel up here. I did a video, previously I did a video over a year ago on what's called the SVIX. And then recently I did one talking about how the XIV and the TVIX might actually be coming back. They've gained approval, and these things, we're just kind of waiting day by day to see them actually launch live. But they were filed over a year ago. They were approved a couple weeks ago. And so these might launch. And the reason I'm bringing this up now, you might want to watch this video. It will explain my whole take on what happens with new XIV, new TVIX, which one will I use, which one I won't. Spoiler alert, I won't use TVIX. I will use XIV. But go ahead and watch the video anyway. The reason I bring it up in the context right now is you said UVIX. That does happen to be the ticker of the new TVIX replacement. It is UVIX. So, but then you said 9.8, so I'm thinking you mean UVXY, or I don't know what's going on here. You're going to have to elaborate. Let me scroll forward and see if you followed up on that. No, you didn't. So Let's save this for later. We'll circle back to that. Maybe you can clarify what you mean. I will help you. I'm here to help, but I need a little more info. What is the VX30? VX30. Okay, well, I'm never going to be able to do it justice in a live stream. So I would definitely recommend you watch this video. It's really to the point. It's 19 minutes. It's worth a watch. You're going to understand the VIX futures. But let me just do a super, super quick explanation here. So what we're looking at here, remember the VXX only uses the front two futures here. We're using April and May, and that's it. You'll notice that the April contract has 10 days left, and the May contract has 38 days left. So what ends up happening is, on this expiration day, when you start the new cycle, after this one expires, the very next day, the VXX will be holding 100% of the futures on the front month and 0% of the back month, just for that first day. And then every day after that, they're going to be selling some of these futures and basically buying some of the back futures in the ratio of the number of days in that expiration cycle. It's equal increments through time. So just for easy math again, the day two, they'll be holding 95% of M1 and 5% of M2, and then 90-10, 85-15, and it'll go through those cycles. And essentially, the VX30 is a calculation we can do right now that shows us where this future is. So I can go to my most recent email here from Friday, and I calculate this every day for people, and I share it with the VTS community. It's one of our metrics. The VX30 constant maturity at 2027. But you'll notice that's actually between these two prices, right? It's not quite M1, it's not quite M2. What is 2027? Well, it's factoring in that the VXX is holding much more of the back month right now than the front month. So it's actually, VX30 is a number in between the two futures. You can always go to the actual website for VXX and you can see what they are holding at any time. So you can, hold on a second. Let me see if I can go this a different way. No, their website seems to be down. If you go to their website, you can actually see the exact percentage of what they are holding. It's not terribly important, but if you wanted to see what it kind of looks like, sorry, my spreadsheets this is just one of like 6 spreadsheets that I have. But, just as an example, the M1, M2 here, if we scrolled across, we could actually calculate what the VX30 is based on the fact that every day it scrolls 5%. It's not always 5.26, 4, 5.26, but we can calculate the VX30. And then based on the value of that contract in relation to how it's moving with the VIX index, that's how the VXX derives its value. So again, that's a super, super poor explanation, very limited explanation of the VX30, but it is an important value. That's why I share it with my community every day. And I tell them what percentile we are in, how it compares through history. Very, very important number, because that is the VXX essentially. I mean, not directly, but that's one of the major key components that you need to understand to try to gauge what side of this trade we should be on, this crazy long short vol trade that we all participate in. So yeah, I would check out that 20-minute video for starters. It's much, much better than what I just did. Can we estimate future VXX values based upon an average amount of Contango, i.e. after 4-to-1 split estimate, VXX based on Contango delay of 2.1 per week? Well, the K factor won't be affected. Nothing will be affected. The VXX will behave exactly the way it did before. So I don't know what the split has anything to do with this. It certainly isn't. So I'll just sort of attack the first part of this. Can we estimate future VXX values based on the average amount of Contango? Yeah, sure. Contango is only one input of, 20 that I use, but it's one. It's one of a list of many. So what you could do if you wanted to sort of entry level, start building your own quant strategies, go ahead and figure out what Contango levels lead to what future prices in the VXX. Now, of course, that is not predictive going forward, but as an investor, you have to understand the simple concept that all things being held equal, tomorrow will most likely look similar to today or to yesterday. It's one of the fundamental assumptions that you need to take. Otherwise, you're going to be a contrarian, and that's not going to make any money. I mean, try to be a contrarian with a short vol mindset. You're going to be losing an awful lot of money. You're going to be joining all those people that email me 5 times a day talking about how they bought the VXX or they bought the UVXY, and now they're down 50% on their money and they don't know why. That's contrarian mindset, where you think, oh, everything's stable now. Now's the time to buy the VXX. That's being a contrarian. I would suggest you be a trend follower. And the mindset of a trend follower is, on balance of probabilities, tomorrow will more likely look like yesterday. That's just a basic assumption. So yes, given that premise, we can say, you can go ahead and calculate, 3% Contango. What is the likelihood of future VXX decay? 5%, 8%. You can just start building spreadsheets. That's why my spreadsheets get so big it crashes my computer, because I've been doing this for 15 years and I've got so much data. Every time I have an idea, I go ahead and calculate it. Now, I don't mind you asking me. That's the point of live streams. But take it a step further. Go ahead and run with this. I would suggest this is a very good question to ask. Excellent question. If the VXX is based on the VIX futures, and if the VIX futures are in Contango 84% of the time, and if the VIX futures are in Contango, that more likely means the VXX will decay, how about we start putting some numbers to this equation? That you're asking all the right questions. I would say start a spreadsheet and start following through on this. And hopefully in a few years, you have spreadsheets large enough that crash your computer too. But yes, very short answer, yes. I wouldn't say, yeah, no, you said it right. I thought you were going to say predict. Estimate. Yeah, you can estimate. Absolutely. You can get very good on balance of probability estimations of what will happen tomorrow. It's not predicting the market, but it's certainly aligning your trade with what is most likely to happen tomorrow. And then, of course, you need to layer on a million ways of risk management to make sure that you're able to get out every time you're wrong, because you're going to be wrong a lot. I'm wrong all the time in my trading. I'm right more than I'm wrong, but I'm wrong a lot. So I need many, many additional layers of risk management to make sure that I don't do anything too stupid. So, but yeah, you're on the right track there. Good questions. Okay, Sasha, we enter long VXX puts when we have a mathematical edge. Why should we cap the gains via shorting the downside puts? Why should we cap the gains via shorting the downside puts? I assume your question is, why is the tactical vol trend following long VXX put options? And why is the vol trend basically trend following using short VXX put options? Why would the vol trend strategy cap the gains when you're selling the puts? Is that your question? The first part, one of the reasons I like stock replacement on VXX so much is because it is a pure trend following strategy where, a lot of times I'm kind of known as the guy who warns heavily against shorting VXX call options, naked calls, especially naked calls on UVXY. I will always tell people that's a ridiculous thing to do. The only people that tell you to do that are people who are on Twitter. There's nobody who manages a fund. There's nobody who is a successful trader. Nobody who has a long-term track record that they can show you actually sells naked calls on UVXY or VXX. And there's many reasons why, many risk management reasons why. But one of them is very simple. If you sell a naked call on the UVXY, you are still subject to 100% of the losses on that trade. If it spikes up, you realize every little tick on the way up. But if it goes down, you only get that initial premium. So we are in a position, like I said, where, look, vol crush is at such extreme levels right now that, we're in the 99th percentile of vol crush, right? So you look at a person like me who bought the VXX put options with stock replacement. I realized every tick lower on that trade. Somebody who sold UVXY call options for 5 weeks in a row, sure, they got 5 weeks of easy premium, but those premiums are just pennies. They're just a fraction of what the trend follower gets. So, why would you put yourself in a position where you are still subject to 100% of the losses, but you're only, even in the best case scenario, you're just going to get your weekly little premium. You don't get to participate in that, long-term trend of the short vol trade. You're going to need those profits because something terrible is going to happen when you least expect it, and your naked UVXY call is going to go through the roof on you. You're going to need the gains from following long-term trends in order to offset those losses. You're going to need that money. It's just a silly, inefficient, that's why I always say the only people that ever talk about selling UVXY calls are people that are never going to show you a track record. They're never going to manage capital for a real person. It's just a Twitter thing, right? It doesn't make mathematical sense. It's the least efficient way to do it. So all of that little rant, and for people who are new to my streams, I do tend to go on these little rants from time to time. Sometimes they're golf analogy related and whatnot, but that's one of them that will trigger me oftentimes when people say, well, hey, if it goes down every week, why don't we just sell naked calls? That's just the dumbest thing ever. I mean, no intelligent investor looks at that risk reward ratio and says, yes, I want a piece of that. It'll get tons of followers on Twitter, but it won't ever make you any money. You'll lose far more when it spikes on you. So the question is, to get back to where this happened, I suspect your question is getting at, why do we sell VXX put options? Well, that has to do with the fact that the vol trend strategy works with a 20% allocation in our portfolio because the rest of the portfolio is allocated long. Sorry, I'm opening up more and more windows here. The reason that we can do that is because 20% of the portfolio is selling VXX put options out of the money. So all of them can make money at the same time, but all of these four are allocated aggressively right now. So we do want a little bit of action that is not completely correlated to the other four. That's what this strategy does. It kind of jumps in there and says, well, under the conditions that these four are allocated so aggressively, I mean, my portfolio's gone up pretty decent clip lately. So I don't mind selling some VXX put options. But like I said, out of the money to make sure that both the portfolio and the VXX put options can make money at the same time. I consider selling VXX puts a short vol strategy. I know a lot of people look at that and they say, well, no, that's a long vol strategy. You want VXX to go up so you can collect your little premium. That's not what I want. What I actually want, the price, the last trade we took, for example, it was VXX was trading in the 11s. I sold the 1050. You might think to yourself, well, that's a long vol trade. He wants the VXX to go up. He's going to get his premium. Actually, no. I want the VXX to go from 1150 down to 1050, right at my strike, just not through it. And then if that happens, my whole portfolio makes money at the same time. So it is technically a short vol strategy. It's just not, like this person is asking, it is not a pure trend following strategy. But that's very, very different. Selling put options on VXX versus the completely silly risk reward profile of selling naked calls on VXX. Not at all the same comparison there. The risk to selling put options on VXX is always very limited, right? Because the UVXY can't go from 5 to 1 in a day. It can double or triple in a, you get an October 1987, all of those people on Twitter who thought they were geniuses because they were just, oh, I'm just going to follow it down. No, sorry. You actually needed all that profit that you gave up selling for pennies when you could have been trend following. You're going to need that to offset your eventual losses. So I don't know if I got this question right. Sometimes in a live situation, I don't fully absorb what the point is, but hopefully in that rant, there was something useful for you. Okay, how do people earn money from VXX if it is decaying? This is the question, isn't it? This is what all of us short vol traders, this is all of our time is spent trying to answer this question. Nobody has the perfect answer. There isn't one, but there's levels of efficiency. That's why I always rank the levels of efficiency. Long put options, stock replacement, it's a very efficient trade because it trend follows, and it's not subject to all the losses. So it's actually better than 1-to-1. The UVXY calls is the worst, right? The least inefficient because you're subject to all the losses and very little of the gains. Terrible risk reward. On the other side, the long put options aside from the lower delta factor, you still make all the money based on your delta, but you don't lose all the money because you're also long Vega, and you can only lose what you put up for the trade, which is always significantly less than the actual capital required to hold the VXX. So that's a good risk reward profile. But there's levels to this. So answering this question, what you want to do is you want to find for you your first level of success, right? For me and for probably several of the people in the comment section right now, we have over the years built up several ways to layer our victories along the way. It sounds like you are trying to find your first one. So start with the VIX futures. Try to figure out what the VIX futures are doing and how that might affect the forward pricing of the VXX. That would be the first thing to check. And then once you start to find a little bit of area where you have an edge, then you're trying to build on your edge. So long term, the decay is to our advantage. But as I alluded to before, the worst thing people can do is just make the automatic assumption that simply because this chart is so hard downward sloping, that suddenly means that anything you do on the short vol side is going to be successful. That is so not true. I can't even articulate how wrong that assumption is. So please be careful. But yeah, you're just looking for a little victory. So I would start with the simplest form of the VIX futures term structure. Study what that means. As I told the previous person, figure out different bandwidths that lead to better success in a backtest, and then start trading, probably paper trading, for a good 5-6 months. Don't risk real capital until you really know. And go from there. You'll start building your edges just like all of the rest of us had to do. There is a way to profit from the short vol trade. The problem is there are many more ways to lose more money than you make. So, yeah. I never answer questions with absolute hard numbers because that would allow people to calculate very quickly what my average or what my annual income is, and then we're getting into the whole net worth thing. This is why whenever I'm trading, I'm always showing a test account in the, let me just open it up. I'm not dodging this question. I wouldn't, if it was private, I would just tell you. But I just ethically speaking, I think talking about money and income is pretty silly. As they say, talking about income is gauche. So what I typically do is I don't hide any of my account numbers for this account. This is the account that we started when I started doing my live streams. So I started on October 29th, and yeah, we're going to the most recent date. So I don't mind showing this, and I don't mind showing the VTS community from 65 countries, but I will never show my income. I'll never show, I just don't want to talk about that stuff. There are so many services and gurus and silly people out there who think that if you stand next to a Lamborghini, that means that you got the Lamborghini because of your trading prowess. It doesn't. How do you know that money didn't come from their person's, an inheritance from their grandmother? You have no idea where that money came from. So I've just set out, I started doing this over a decade ago. I've always just held true to the fact that I'm never going to flash money. I'm never going to talk about income in any way, shape, or form. I'm never going to show you, a luxury lifestyle. It's all silly. You have no idea if I won the lottery. You have no idea where that money came from. I could be the worst trader in the world, but I received an inheritance from my uncle. I mean, who knows? So if I tell people how big the community is, it's $89 a month. It's just quick on the calculator, and oh, this guy makes that much money. No, not going to do that. But I've told the community. I've told my private community. They more or less know. I'm sorry. I hate punting on questions. Live streams, it's my policy to literally answer everything that comes in. You can ask me anything, but I'm going to have to tell you politely, no, I do not want to share my annual income with people. It's not my style. That's not how I'm going to get people interested in my work. I'm going to get them interested in the work by doing the actual work. So why do you have an edge when you enter a put option in VXX? You think the market maker doesn't take that into account? Interesting. Did I say that you... I don't think you have an edge just simply by virtue of entering a put option. Oh, I know what you're saying. This is in response to somebody else who said, yeah, I remember that now. I think what you're saying, yeah. Okay, again, this I might be missing the point here, but I think what you're getting at is somebody may have alluded to the fact that because this chart looks like it's diabolically sloping downward, that, well, obviously the smart money just buys repeating put options on this thing, right? I mean, that must be a profitable position because, as we all know, the VXX constantly goes down, right? At least 82% of the time, it has a headwind to go down. So the smart money's to buy the puts, right? Only a fool would go otherwise. Well, turns out, like I just said, as we all know, the VXX has a decay factor. The options market's very efficient, and that, as we all know, part is pretty important. The fact that it decays is already factored into the option prices. There's no edge in saying, well, the VXX goes down long term, so certainly the put options are profitable. No, there's zero expectation that rinse, repeat, blind selling or buying of put options would be profitable in any way. It would be 0% minus trade fees. So I think that's what you're getting at here. You're pointing out the fact that the options market's efficient enough to know that already, and it's already factored in. And that is, if that's what you're getting at here, that is an absolutely true statement. You should never assume that you know something that the market doesn't. We all know it goes down. So the put option premiums are much more expensive than the other side of the trade. And yeah, sorry, I'm trying to catch up. Sometimes I love when people are chatting in the comments. Talk amongst yourselves, it's fine. But sometimes I kind of miss. I feel like I'm playing catch up there. But I assume that's something about what you're saying there. Yeah, there's no edge in that. You need an actual edge, a informational edge, a timing edge, a portfolio structure edge, something to get above and beyond that 0% minus trade fee expectation. If VXX is doing a reverse split, why are you taking out your VXX? I would just be taking it out simply because, again, I covered all the reasons why there's a net zero change for the trade. I don't need to close it out. It's just that being mindful of the future and understanding that eventually I want to close that out, and just the way that strategy works, the time that I'll be closing it out is very likely when the VXX is going up, right? I'm moving from, everything's safe, green light, to, wow, this is getting bad, it's time to move to safety. That's when I'm going to be exiting that trade. And so I don't want to take any risk of, even though it's lower risk and it's probably not going to affect things, I don't want to take the risk of the liquidity being an issue. So why not just exercise the materially identical trade with the new option string that will be in existence over time? It's just as I said, best practices, not required, but certainly no harm whatsoever. So yeah. I accidentally found volatility trading just this week. I made the mistake Wednesday of call options on UVXY and got burnt bad. Buying long call options when it's decaying. Yeah, it's buying call options on UVXY is a good way to get burned. Selling call options on UVXY is an even better way to get burned, because while you will get a very long string of easy victories, you will wake up to very bad days once in a while. So, and again, you're not making enough on the profit side to cover those bad days. So it's a terrible risk reward profile. But yeah, unfortunately, when people enter this volatility space, and you are not alone, I'm not picking on you here. I totally, and I'm actually, this is fantastic that you did it this week and you've already realized. Some people will go years trying to just bang their head against the brick wall of trying to predict the next volatility spike. That's how people enter the volatility space typically. I did a video on YouTube where I actually opened up my trading account back in 2010, and I showed the first series of trades that I did on the VXX. I've been trading these products since they launched, from the very beginning. Because I was an options trader since 05 or something, once volatility products launched, of course, they were on my radar. So I actually made a video and I showed that sequence of my first series of trades. And my first one was a long VXX position. So I happened to, luckily, make money on that very first trade, but it was a terrible trade. I actually pointed out that the VIX futures term structure, when I opened that trade, in 2010 was steep in Contango, and it was a terrible signal to take. I just got lucky. But you're not alone. Most people come into it thinking UVXY and VXX are a really great way to try to time the next volatility spike. Of course, it's not. So I'm glad to see that you learned your lesson quickly. And there's no edge in long or short. It's neutral. If you have no information and no edge, then you can't play either side of this trade. You have to start layering your edge to make sure that, again, on balance of probabilities, you make more than you lose. You've got a good risk reward profile, things like that. Take it from 50-50, which is just blind guessing, and try to get it to 60-40. Try to use actual edges to get to 60-40. That's kind of the goal of this whole thing. Yeah, I think I covered that. So you clarified that was kind of your point. Yeah, there is no edge in just buying a put option. Yeah, we all know it goes down, but you're paying a lot to buy that put option. Of course, it's like the VIX, right? We all know it's kind of mean reverting, and don't bite my head off. I also know that it's mode reverting. It's mean, median, and mode reverting. It's all three. But we know the VIX is going to go up eventually. We know it's going to spike. But there's no edge in buying VIX calls, just going to buy VIX calls. Those VIX calls are expensive, and you're going to pay for that on the front end. So even if we all know something that will eventually prove 100% correct, you're still paying so much money for those calls that even when it does start to go up, there's a threshold there where you haven't offset your losses from the initial, steep, heavy upfront premium. Same as VXX put options. There's a pretty steep upfront headwind there when you're buying expensive puts. So you have to make sure that you're only doing it at the right times. I only do it when my signals, as I showed, are actually conducive to that trade, right? There is my strategy for the VXX puts. It's only allocated 42% of the time. We're in cash 58% of the time with this strategy because there's plenty of times where buying VXX put options is not a good idea. So, just doing it blind because we happen to know that it looks like this. No, don't let your brain connect those dots. Those are not the same thing. A chart that looks like this can still cost you all your money. Yes. So the public streams, we do more private than public. But the private streams, sometimes I edit and include something cool that we talked about, but otherwise they remain private. The public streams, like this one, as soon as I click end, which hour 22, maybe I should click end soon, but I'll try to get to a few more questions. It'll be available publicly. You can watch the whole thing over again. I think it's available almost immediately. I think you are from India. Yeah, there's people chatting. That's pretty cool. I like that. I'm trying to build a community atmosphere, and it's obviously difficult because everybody's got their own things to do. But yeah, go ahead and chat amongst yourselves. Chat with me. I actually like doing live streams. I'm still very nervous. I'm a nervous person, terrified of public speaking. When I did my first stream, I couldn't even remember what I was saying. This is hard for me, but it's actually kind of fun too to interact with people. So I don't mind doing it. Were you a quant trader at a hedge fund prop shop prior to doing this? If so, would you mind telling us where you worked? No, never worked in the financial industry in any official capacity. Yeah, I mean, I get offers all the time. Every week somebody wants to work together, but no, I've done it myself. I used to be a professional golfer. I retired in 2005 and immediately started option trading. That was just my job. And I actually did that full time for 6 years. No other income, just trading options. That's why I have a few videos on YouTube telling people don't be a full-time trader. I made a great rate of return, and it's still hard to get ahead because you're pulling profits out of your trading account to actually to pay your bills and pay your rent. So it was a very rewarding experience, but it was also a dead end. So that's why in 2011, I decided I had a public website in 2009. It was called vixtrader.com, where I used to share every month my performance going forward, and used to write articles and explain what I was doing. And a bunch of people used to reach out to me privately and ask me if they could, pay me $50 to send them the signals ahead of time and they could follow along. So in 2011, I, put two and two together in my head. Well, I do need an income, so I can either put on a suit and tie and go down to Wall Street and work there, or I could just take this person's $50 and send them my trade signals, ahead of time on the same day. And that just snowballed into a subscription service. So this is what I've been doing ever since. And I've never worked in the industry in any capacity. Now, what I can say, I don't know if everybody knows this or not, but I actually do have a consulting firm as well, have for a number of years, long time, almost as long as VTS. It's called Prosperitas Financial, where I'm essentially consulting to hedge funds and financial advisors. And I do work with a lot of people privately. They pay me as a consultant, but nobody's ever hired me as sort of under their banner of their company. So I prefer to do things on a consulting basis. A lot of advisors and hedge funds and whatnot, family offices, they are using my signals in some capacity, but I don't consider that an official position. So officially, I've never worked in the financial industry. And I can say, never say never, but I can say with reasonable confidence that I don't see that as a direction I could go. I could, because my portfolio is highly conducive to being starting my own RIA, say in Canada. But the problem there is that I like to travel the world. I'm a digital nomad. I don't really have a permanent home. I just travel around. That's why I said you'll see this background change constantly throughout the year. I don't want to move back to Canada. I haven't lived in Canada for 18 years. I don't want to move back to Canada and be an advisor. So even though my business could be very successful doing that, I like what I do. So no, never done any of that. Everybody has to find their own path. I think I wouldn't be against people starting their career doing that. I think that'd be good. You could learn a lot. I'm a total workaholic. So I was able to, starting in 2005 as a trader, right after I retired from golf, I was able to learn in 2 or 3 years what it would take most people, 8 or 9 or 10 years, whatever it is. Just because of my work ethic back in my golfing days, it carried over. So I just didn't feel the need. Maybe I would have learned some cool stuff, but I just didn't feel the need. I like doing my own thing. That's why my business doesn't look like anybody else's, and my portfolio doesn't look like anybody else's, because it is entirely my creation. That's why my golf swing didn't look that great, because I've never had a golf lesson either. I built my own swing, and it looks a little weird, but it gets the ball in the hole. So that's all you really need to do. My puts. Sorry, I was distracted by that picture of your Stars and Stripes pants there. My puts bought on Friday with the strike at $10 for the next Friday on VXX. What is going to happen to those after a reverse split? So like I went through about a 25-minute spiel at the beginning of this stream. I would imagine you missed it. No problem. Welcome. You can watch the live broadcast afterwards, by the way. But real short, because I don't want to bore everybody else. But essentially what's going to happen is nearly nothing. It'll all probably look about the same on your end. The only difference is on the back end, when they settle the options, it's going to settle at a 1-to-25 ratio instead of a 1-to-100 ratio. And there's just going to be a little bridge benchmark there that they will use. And then that'll be it. It'll be gone. And this'll all blow over as if nothing happened. The general point of today's stream, although we have been going for an hour and a half, was nothing's happening. A reverse split is a ceremonial, nominal number thing only. It's not going to affect anything with the actual value of your trades. Both long, short, that value doesn't change, and with options, that value won't change. You're good to go. Like I said, don't forget though that eventually you're going to have to close this position, and you might not want to be closing positions after the split has happened. Best practices, you might want to close it beforehand and just initiate the same trade again for the following week out. You can always do that with options. All right. What is the risk of hour 29? Yeah, let me see how many questions are going. Because if I short, I mean, there's a million questions. Sorry, there is no chance I'm getting to any of these. And so many of them look good. I'm so thankful that all the people that are watching, there's no bickering, there's no haters. You know, I'm just so happy that the VTS community, and they're just so respectful and knowledgeable. Everybody asks really solid questions, and yeah. Unfortunately, I'm not going to be able to get to all of these. So I'd prefer to do more streams that are shorter. So I'm going to stick to that. This is the second last question. I'm going to go one more after this. Okay. What is the risk of shorting short-term volatility and longer contracts when the VIX is in backwardation, doing some sort of calendar? What is the risk? The risk is what a calendar risk has. Calendars can be risky. They can lose. I mean, it's a long trade, so oftentimes people think, oh, I can only lose that premium. I mean, technically true, but you have to remember that you're doing 2 different months with 2 different implied volatilities, and it doesn't have to move uniformly. So calendars always have a little bit of uncertain risk built in there. It's not quite like an iron condor where you can actually see mathematically what's going to happen ahead of time, or a vertical spread. These are sort of hard, concrete things that we can get real answers for. Calendars have their own, and diagonals as well, they have their own little intricacies. And so that's the only risk. But if you're ever in a situation where you have an actual edge that tells you that this is a good trade to initiate, then it's a good trade to initiate. I trade calendars quite often in my option trading. Nothing wrong with the calendar. What I would say is make sure that it makes sense at the moment. Because there are times when calendars are a really appropriate trade, and there are times when it couldn't be worse, right? So calendars are not something, well, no options are something you can just blindly repeat, but calendars specifically are something that only work in certain environments, and their advantage is limited to specific situations. So make sure that it's coming from edge, not constant blind rolling. That's always going to lead to the standard pretty close to 0% minus trade fees. But there's no inherent risk like, oh, calendars are dangerous. They're not. You have to understand that you're pitting 2 different implied volatilities against each other, 2 different time frames against each other, and there's nothing saying they have to move uniformly. So, and quite oftentimes, just as a side note, when people flag a calendar as an appropriate trade, quite oftentimes that is when the front end volatility is really elevated. So there is always that, if you open them at the wrong time, it can really go against you quite quickly. So just stick to actual edge, not rinse repeat kind of things. And this is the last one. So April 23rd is split date. So I just read that means market crash is imminent. Okay. Agreed. On the 20, I wouldn't want to be a trader on the 24th. Fortunately, it's a Saturday. So yeah. All right. Excellent presentation. Thank you. Thanks everybody for coming. If you wouldn't mind, before everybody just bails on me right away, please just on your way out the door, just hit the like button. It will mean that the video will rank a little bit higher. I always hate asking. Everybody who makes YouTube videos hates asking, but please just on your way out the door, hit that like button. Remember that if you follow me on Twitter, you will be notified of any future streams. And because I'm actually getting pretty good at keeping them short, we can start doing more of them. So I mentioned it last week, but one topic that I want to get to, so I'll just give a little teaser while you're all here. I want to do a stream probably this week. Maybe I'll set it almost confirmed this week, talking about the ARK fund. It gets a lot of attention. Should we be using the ARK fund within our tactical strategies? Is there a place for it in my portfolio? I want to go over, just kind of dive into what it is and how it moves, and basically explain to people that there are other more safe, actually better ways to invest than going into something that is, as risky as those ARK funds are. But I want to go through the full numbers and show everybody what I'm talking about. So stay tuned for that. You'll find the notification on Twitter if you follow me. And that's it. I'm going running. Hopefully everybody enjoys their weekend. It's Masters weekend, so if you're a golfer, I don't know, who's your guy? I like Justin Rose, both his game, but also just personality-wise. I've always liked him. pulling for Justin Thomas. Tony Finau, like him too. It's going to be a good one. So thanks, everybody. Catch you on the next stream.